Good afternoon, everyone, and welcome to our event, Student Loan Cancellation is Cancellation What Our Economy Needs. I'm Tim Shaw. I'm the Senior Policy Manager at the Aspen Institute's Financial Security Program. This event is one in a series that the Financial Security Program is hosting to highlight the research, knowledge, and policies that can help businesses and policymakers triage the immediate effects of the current pandemic, design solutions that allow households to recover, and address the structural challenges to stabilize financial security at the household level in the long term. Our research is made possible with support from the Annie E. Casey Foundation, MetLife Foundation, the Prudential Foundation, and the W.K. Kellogg Foundation. Student loan debt has been a rapidly growing burden on households across America. Last year, total student loans passed the $1.5 trillion mark and became the second largest source of consumer debt for households, second only to mortgage debt. That growth has had growing consequences for households, which is why this has become a key issue for us at the Financial Security Program. And it was pretty clear as the dramatic economic consequences of COVID-19 emerged, the student borrowers would need relief. The CARES Act delivered some of that relief in the form of delaying payments for the 80% of student loan borrowers who have direct student loans from the federal government until October 1st. But crucially, that delay did not include those with privately held loans and other loans not covered by the Act. And also, it's very clear that if any of the projections of the financial consequences of COVID-19 come to pass, particularly borrowers overall and particularly vulnerable borrowers will need relief beyond October 1st. It's with that in mind that we're hosting this conversation on student debt cancellation. The delaying of payments in the CARES Act provides important relief right now to borrowers, but the longer-term assistance will almost certainly be needed for both households and the economy as a whole. Student debt cancellation could be a tool to provide longer-term relief to families, economic stimulus, and be a driver in allowing the workforce to adapt to a changing economy. So that's why we're holding this question here today. We have a fantastic panel planned for later in the program with a number of experts that can speak to the consequences of the student loan system for borrowers, the surprising benefits research has found for the economic benefits, as well as alternatives to student debt cancellation that can be involved in any recovery package. I want to let everyone know that we're going to provide an intro here, but if you have questions for the panel, you are throughout the program. Please do enter them. Our team will be monitoring them, and we'll have a Q&A at the end of the event with the panel with those questions. But to open the conversation, I'm joined now by my friend and colleague from the Financial Security Program, Catherine Lucas-McKay, our resident expert on all things consumer debt to help frame up the conversation. So thanks for joining us, Catherine.
Yeah, thanks, Tim. I'm looking forward to it.
So I've been with this Financial Security Program for about 6 months. And even before I joined, one of the things I most appreciated about our work on consumer debt and student loans was how we look at student loans through the lens of the broader set of the household budget, but also consumer debt as a whole. So I'm wondering if you can kick us off by talking a little bit about how student debt fits in the broader set of consumer debt and the unique challenges and characteristics that come along with it.
Sure, yeah. So if you look at the typical debt portfolio of the median American household, it looks at first like student loan debt might not be a huge deal because of the age distribution of the country, because of educational inequities in the country, for a number of reasons. And that really disappears when you start breaking things down in terms of, for people who have borrowed for education, it's more than half of their debt if they're not homeowners most of the time, so more than half of their non-mortgage debt. And in that sense, it really is something that defines your financial life and plays an enormous role in it, and in ways that we're going to cover in depth throughout the next hour.
Yeah. I'm wondering, as part of this, if we could bring up that first slide on the changing face of today's students. Because I think one of the challenges with talking about student debt is that there's an idea out there that there's a really narrow subset of folks, people going to get four-year college degrees who leave, and those are the folks who have debt. But as we can see in the slide here, today's students, and therefore the folks who end up with student debt in the long term, are actually a much more diverse array of people than we typically assume. 64% of them are employed. It's important to say 40% of them work full-time while they're students, and 24% have children or dependents. So while it is young people that have the kind of disproportionately large amount of debt, that debt is growing for older Americans, and it's not just that kind of narrow subset that's kind of stereotypically in the news that holds and is affected by student debt. It's also critical to mention that students of color hold 42% of today's students, and also, as we'll get to later, suffer some of the more dramatic consequences for holding student loan debt. So you mentioned that the young folks aren't the only ones with debt. Could you talk about the growing amount of debt that older folks face?
Sure. One of the things that was a very distressing trend in the last 6 or 7 years was seeing that one of the fastest growing age cohorts in terms of the rates of holding student loans was older people. And in a sense, it made sense that, younger people have a fairly steady rate of enrolling in school. But what we saw is that in the wake of the Great Recession, it became really important to upgrade your skills in education if you'd been laid off, especially if you'd been laid off and you were older, generally older than 50, there were really big impacts. So people went back to school and they borrowed. And then looking at people in Generation X, which is, the younger end of that is a couple years older than we are. That generation has been paying down their student loans really slowly. So they're now in their 50s, their 40s and 50s, and very slowly paying off those balances over time.
Yeah, I think with that context of the broad set of debt, I want to launch our first poll. So putting up the poll now, do you or someone you currently know have student debt? And the reason I want to ask this is because, we know just from the stats that a bunch of people have debt, and that's a wide issue. But we also want to know from the audience kind of who we're speaking to, and how wide is the knowledge of and the burden of it among this particular audience. I think the piece about folks in the longer term or the older folks that have student loan debt is highlighted by a report from the Government Accountability Office a few years ago that 173,000 people in 2015 had Social Security wages garnished to pay for loans that were defaulted on. Some of that is disability, some of that is old age, the old age insurance, and kind of what we typically think about are Social Security benefits. But when we transitioned to the system of paying for higher education with student loans, I don't think it was in anyone's mind that Social Security benefits would kind of be one of the being garnished would be one of the consequences of student loan debt, and that's going to be only a growing problem over time. So I think we've got most of the poll here. So I'm going to close the poll now, and I think unsurprisingly, what we're seeing with our audience is that 58% of folks on the line have student loan debt, and 64% know someone who does. Only 2% is in the no category. So our audience today is really intimately familiar with this issue, and so this is a good conversation for them right now. So it's important to know that there's a wide array of folks who hold this debt or know or are affected by knowing someone who has it. But it's also true that the impacts of student loan debt kind of are concentrated on a smaller set of folks. Could you talk a little bit more about that?
Sure. Yeah, there's a number of different demographic groups that are more likely than others to be struggling with their student loan debt and to not be seeing the benefits of it. Perhaps unsurprisingly, that includes Black and Latinx borrowers who, both because of wealth differences, intergenerational wealth differences, and then labor market discrimination, have to borrow more than white borrowers and then earn less, thus pay it off more slowly. So it kind of erodes both the income benefits, racism erodes the income benefits to a measurable degree, and then the ability to save and build wealth really suffers. Now, that is for graduates. The other group that is extremely likely to experience distress because of their student loans are those who don't complete school. Most of them stop taking classes for economic reasons. So this is kind of a double hit. You don't get any of the income benefits of higher education. You just have a new bill to pay that blocks opportunities in the future.
Yeah, I think this is a good chance to go to our second slide on the size of student loan balances. I think as a consequence of those important steps that you bring out is that the highest cost of student loan debt actually falls on folks with the lowest balances, which is surprising. On the left, you'll see here is the share of all defaulters that by student loan balance, which means that 66% of people in default on their student loans have less than $10,000, which kind of puts some of the narrative that we think about student loan debt and someone that has $100,000 in debt as being the people who are most affected, but often it's those folks who didn't complete a degree or who didn't get the benefit from their degree and still have a relatively low payment, also have the highest, kind of are most likely to be in default and have the most consequences from holding debt, which I think is a good transition into why we wanted to talk about this in the context of COVID-19 specifically. The student loan debt has a wide array of economic consequences that have been documented, and you've written up in studies before that people are less likely to buy homes, less likely to start businesses, less likely to save for retirement, but it's also this barrier to going back to get skills. There was a Strata poll recently that 1/3 of Americans believe that they would need more educational training to replace a job loss during COVID-19 with one that pays similarly. And I think these stats of like people who have low balances that are ones that struggling really speak to the barrier that student loans can be when it comes to going back and getting the skills we need to kind of transform the economy in the longer term.
Yeah, I think that is something I mentioned seeing in the Great Recession, and something that as 36 million Americans are unemployed now, that we're going to see happen again. And those who have already defaulted on student loan debt that they took out earlier are not able to take on new loans. So the education and training options open to them are much more limited. They also, as we said, those who don't complete have the worst labor outcomes. So they're also much more at risk in the job market right now. And it creates just a really cascading set of problems. And student loans is just one of them, but it is one of them that has an outsized impact on not just the short term, but the rest of their lives.
Yeah. And in the spirit of talking about kind of just one, like student loan cancellation is one policy among a set, it is really important to say anytime we talk about this, that cancellation is a policy for folks who already have debt, have already gone through the system that creates debt for them. I think there's pretty wide bipartisan agreement that we also need reforms that deal with a system that has become unaffordable for a lot of students, and make debt not as necessary a tool in getting to the higher education system. But so there's a set of solutions that are there for people entering the pipeline of higher ed, and also needs to be a set of solutions for people who have already gone through that pipeline and currently hold that debt. And in the context of COVID-19 specifically, and the kind of longer term recovery that economists think it'll take to get out of it, cancellation can not only be helpful to borrowers, but have kind of the add-on economic benefits of people getting back and buying homes, going back to college, getting more skills, and being able to participate in things like saving for retirement and short-term savings that are really critical for household financial security. So we've covered a lot here, and I want to make sure we get to the panel. But before I do, Catherine, is there anything else you'd like to make sure the audience knows?
Yeah, I'd say, we often think about this conversation and have this conversation in terms of, does canceling student loans provide too much benefit to the wrong people? Is it inherently unfair because only some people have them, so only some people would benefit? I'm really glad that we've pulled together the group of folks that we have today, because the conversation does not need to stay there. And I think it's much more productive, particularly now during the pandemic and this recession, to think, what is it that we could do to relieve financial burdens from millions and millions of households in a way that pays off right now, increases spending, helps the economy at a time we really need it, and improves their lives in the long run? It doesn't have to be hugely expensive. There's a lot of different ways to balance those interests. And I'm excited to hear how our panelists think about that from all of their own perspectives.
Me too. Well, thank you for joining us, Catherine. And I want to turn it over to the panel now. So I'll introduce our moderator for the panel, let her introduce everyone else. Our moderator will be Danielle Douglas-Gabriel, who covers economics and education for the Washington Post. As those folks tune in and get their webcams going and turn themselves off mute, I want to remind everyone that I'll be monitoring the Q&A over the course of this conversation, and we'll be popping back on to facilitate that. So if you have questions for our panel when they've concluded their conversation, please let me know, and I'll get back to them with that. So Danielle, feel free to take it away.
Thank you. Thank you guys for joining us today. My name is Danielle Douglas-Gabriel. I'm a reporter at the Washington Post covering the economics of higher education. With us today is Marco Maggio, associate professor at Harvard Business School, as well as Joanna Darcus, a staff attorney at the National Consumer Law Center. And then rounding out our panel today will be Kenneth Megan, Associate Director of the Higher Education Project at the Bipartisan Policy Center. So to get started, I'm going to ask each of our panelists a question just to kind of kick us off, and then we will start to go into a broader conversation about student loan cancellation and other policies that could be beneficial to the population of which we're talking about today. So actually, we will start off with Marco. Marco, what does your research show about how student debt forgiveness compares with mortgage relief provided in response to the Great Recession?
Yeah, so basically we had the opportunity to study one particular quasi-experiment, which is looking at private student loans, and in particular the forgiveness that resulted from National Collegiate losing the paperwork on some of these loans. And so some people got their loan canceled instead of being subject to a wage garnishment rule, and some others did not. And so we could actually compare outcomes for these two subsets of people with the sort of the quasi-experiment of having some people for which the student debt was in default, so they were paying zero before. And then after they went in front of the judge, and judge ruled that there wasn't enough paperwork to show that they actually owned the debt in the first place, they also went and they forgave the loans. So they were paying zero before and they were paying zero afterwards. Some other people instead went there and were subject to the wage garnishment. And so we could compare basically these treated guys against the control group. And so I want to highlight just a couple of things that I think might be helpful to inform a little bit of the debate, and also some numbers in terms of what are the benefit and cost of a policy like forgiveness. So the first thing that I want to highlight is that there are a couple of effects that are sort of unexpected. One is that once we track down these people over time, we show that the ones that experience the forgiveness, what they do is actually they delever. So actually their total indebtedness, excluding the student loans, goes down over time. That, I think, is unexpected because a lot of the narrative around helping people that are already in default or in distress is around the idea that these people are not financially responsible, and so why should we actually help them in the first place? We are just sort of postponing their defaults in the future to other accounts. And instead, that's not what we find. And so that's very much speaks to the fact that people might be in default for a variety of reasons, from health shock to unemployment shock to not being able to finish their degrees, and helping them out actually make them improve their financial health over time. The other effect is that also it's never talked about, is about externalities. So rather than a forgiveness being a transfer between, in the case of federal loans, between taxpayers and borrowers, what we find is actually that there are effects to the overall economy, not only in terms of these borrowers being better consumers because now they have more money, but it's actually that other creditors of these people are also benefit from forgiveness in the first place. Why? Because as these borrowers lower their balances on their accounts, they're also significantly less likely to default on other accounts as well. So that's also a benefit that goes to credit markets overall. And then there are effects that speak a little bit more about what are the debt overhang problem associated with the student loans. One is that we find that the borrowers that whose debt to get forgiven are significantly more likely to change their job, to go to a different industry, and overall to increase their income by more than 2 months' salary over a 3-year period after the forgiveness. And sort of the mechanism that we find is that the debt overhang issue related to student debt is distort the choices in the labor market as well. In particular, people might get stuck in a job that might be secure, but is low pay and is low risk. What we would like these people, especially at the young age, is actually to take risk and potentially be subject to more volatile income. But if it turns out to be okay, basically this income might grow over time. And that's exactly basically what we find. And then the last effect that I wanna highlight, which is also related to some of the points that have been made in the introduction, is that there are intergenerational effects. In particular, parents might step in when the students get in trouble. And that might be also one of the reasons why some older people might turn out to have student debt on their accounts, is because they are, first of all, a guarantor. And so when the students end up in trouble, end up defaulting, ultimately, they step in and might help them. But obviously, this distort also their own position, make the overall household sort of significantly more fragile. And this might, that's also related to why many people don't have enough, for example, on their 401k, because they have now spent on their children student debt balances. So overall, if you put all of this together, you wouldn't expect any of these effects if you were talking about mortgage. Why? Because after during and after the last financial crisis, there have been quite a few policies helping banks to modify the mortgages. For example, there was the Home Affordable Modification Program. And the headline effect of those programs were that anytime you change the liquidity for these people, so you change the monthly payment, you're going to have effects, positive effects on these people, both in terms of defaults as well in terms of consumption. If instead you just change the principal, so you forgive some balances of these mortgages, you're not going to see much effects. And so the fact that we find a completely different effect in the student loan market, it also speaks a lot to what type of the distortions come together with having this burden on the shoulders of these younger people.
Thank you, Marco. Joanna, I wanted to ask, how should student loan cancellation be considered in the context of larger student loan reform?
When we think about any policy intervention, we have to think about what kind of problem we're solving. And we have a broken student loan system right now where the folks who can least afford to pay for higher education are the ones who are saddled with debt, expected to repay it, and often have limited means and resources for doing so. That means that their debt gets more cumbersome and impairs their choices as they go through repayment, and they're often likely to suffer default. So when we think about debt cancellation, we have to think about what kind of problem we're solving and how we can make sure that the low-income clients that the National Consumer Law Center advocates for, the people of color, the women, the veterans, all of the folks who are struggling to access higher education and then afford to pay for it, that there's a result that is meaningful for them and transforms their lives. So there are a lot of different policy options that we could consider. Debt cancellation is uniquely efficient and elegant in that it would help us tackle both the student loan debt crisis, all of the effects of carrying debt regardless of the amount, but sometimes because of the amount, and also the student loan default crisis. So we see that people struggle to repay their debt because of the need to make ends meet at the same time, and because the cost of living is high. And we also see that folks who have struggled but entered default are facing draconian debt collection consequences that they can't afford or bear. So when we think about debt cancellation, it's the best solution to these sets of problems, and any problems that we're identifying. If we want to think about other policy interventions, we've got to find ways to fix repayment and also fix default. And if we're fixing repayment, that means we have to make it actually affordable for people, protecting income that's necessary to provide shelter and food for families, at the same time that we are ensuring that there's a light at the end of the tunnel and this debt won't be hanging over their heads, preventing folks from starting families, buying homes, starting small businesses as they move forward through their lives. Also making sure it doesn't prevent them from retiring with some financial security. And then as far as default, to the extent that we keep a definition of default, we've got to make sure that we restore a statute of limitations on the collection of federal student loan debt, and ensure that we protect people who are receiving Social Security benefits, whether that's for retirement or disability, from having those limited benefits siphoned away to repay their student loans. I also want to make sure we protect the earned income tax credit from getting swiped by as a debt collection mechanism by the federal government when folks fall behind on their student loans. We got a lot of policy levers. There are a lot of options. We put them all on the table. We work in coalition with a lot of groups on these issues all the time. And we raise those in the context of Higher Education Act reauthorization, and are happy to bring those to the table. We're particularly interested in debt cancellation as a way to tackle the system head on, so we don't have to look for piecemeal solutions. And because we know that in the process of repaying debt, borrowers of color, low-income borrowers, are so likely to face challenges. Whether it's with servicing errors and abuses, whether it's just because they got ripped off by a predatory for-profit school in the front end, or whether it's because life intervenes and we're in a pandemic like this one. There's a lot of change that's needed, and debt cancellation offers true opportunity for system reform that would transform the lives of our low-income clients.
Thanks, Joanna. Kenneth, it seems like we're at a point where student loan cancellation is really having a meaningful conversation moment, especially in the next wave of the relief package. The Democrats are pushing for it in one form or another. But if not cancellation, what would be a better policy prescription to help borrowers right now in this moment and in the long term?
Well, look, I think all the other panelists and the intro speakers laid out a lot of the challenges affecting borrowers. And it's true that there are a lot of borrowers who are struggling. For example, half of new borrowers are unable to reduce their principal balance within 3 years of entering repayment, so they see negative amortization over that time. 39% of the federally managed portfolio is either delinquent or in default. Surveys that we conducted in January indicated that half of borrowers see their loans as adversely affecting their physical and mental health. But that said, there are also a lot of borrowers who are doing very well for themselves. For example, in the middle of our pandemic right now, college graduates have an unemployment rate that's roughly half of high school graduates at 8% compared to 17%. Also, the folks with the highest debt levels tend to have master's degrees with higher wages. So for example, the median dentist takes out $230,000 in loans, and 78% of dentists borrow for dental school. That's compared to median loan debt of about $24,000 for teachers. So again, what Joanna said, we really need to think about what problem we're trying to solve here. And in the context of COVID-19, I'm not sure that widespread student debt relief is the right answer. So if we're talking about a $1.5 trillion pot of money and how we can allocate this the most effective way to support people who are financially vulnerable, I'm just not sure that spending all of that money on total debt forgiveness is the right move, because again, folks with high incomes tend to have higher debt levels. But I could see definitely an extension of the suspended loan payments that's here right now. Also, having loan payments suspended for 100% of borrowers instead of 80% of borrowers. I think that's a good starting point. I also think there is a rationale for forgiving debt in bankruptcy or severely delinquent debt. So if you've been delinquent on your student loans for several years, there's definitely a rationale for having a fresh start. And I also think more consideration needs to be put into very targeted loan forgiveness that's perhaps linked to means-tested benefit programs. I know that that the Aspen Institute recently released a report that talked about this. I think that is something that should be explored as well.
Okay. I'm going to ask this to the group, but just kind of keeping on the latest iteration of the relief package, there was a lot of controversy, especially from the consumer advocacy community, about the recent version narrowing student loan forgiveness to those who are considered economically distressed. What are the challenges in defining who is economically distressed?
Well, I think this is the question of the day. I mean, we've seen Elizabeth Warren and others talk about a wealth tax. I think if you can figure out a way to measure assets, that would be the best way to figure out who's financially distressed. But the problem is it's really difficult to measure assets. The IRS doesn't have a way to measure assets. The wealth tax, folks have been talking about how this would be very difficult to operationalize, creating a lot of weird incentives for the super rich and hiding their assets in art or other things that are difficult to measure. Income isn't the best measurement because, as Joanna mentioned, there are these long-standing discrepancies, and I believe Catherine mentioned this too, based on race. So just because you're earning $100,000 or $200,000 a year doesn't mean that you're doing particularly well, because there's huge variations in assets. So I don't know if we have an answer.
Anyone else want to contribute to it?
I think that's a super, I think, interesting question. It's at the core of debate. That's the reason why when sort of people advocate for total forgiveness, I'm sort of cringing a little bit, because I'm much more in favor of a plan that is at least income-based, which will cost significantly less and help the ones that really need the most. Especially, you know, if you relate this to what we just heard, which is that most of the people that are in default 3 years after graduation are actually people that have less than $10,000 in their balance on their student account. And that means also that the total cost that is attached to a bill that leads to forgiveness, without any definition of distress, is sort of significantly less if it is targeted to people that are low income in the first place. I do understand that in the end, it's a game of what can or cannot pass, and maybe not even this will pass. It's most likely. But I think one challenge of defining what's in distress is not only sort of the topic of the wealth tax, which, by the way, I mean, the Scandinavian countries have solved. So there is a way in which you can measure assets in a credible way. But even without that, if you think about situation in which people are struggling to repay their student loans, and they're making choices that are hard choices between keep repaying because they know that that's the only loan that is not dischargeable bankruptcy, versus paying school for their kids, or having food on the table, or sort of anything else to avoid wage garnishment, which is also attached a huge stigma to it. That already basically brings you to a definition of distress that is significantly wider than the one that Congress has just adopted. there is going to be sort of a trade-off, right? If you go wider, there are going to be people that in the end are not going to be in distress and are going to use this just as an easy way to avoid repayment. And we have to sort of figure out the cost benefit of this, whether it's worthwhile actually taking that cost and helping people that need the most. I think there might be ways in which we can do this, and we can build on that definition that only rely on the defaults, especially if you think that forgiveness has a sort of what I call a multiplier higher than 1. Right? So $1 of forgiveness, if that actually translates in 1.1, $1.2 in the economy, that's actually a great trade-off I would take. That's what sort of we find in that paper, because if you put all the effects that I talked about together, you actually find a multiplier higher than 1. So actually that's a great investment. And if we start talking about that, probably some of these policies might look more appealing.
And I will briefly say that as soon as we start targeting debt collection, we just have to, debt cancellation, we have to make sure that we hit the target. And the compromise that was struck doesn't actually alleviate the debt burdens for all of our low-income clients. So when you look at people who are essential workers right now, who are working in grocery stores, who are stocking shelves, who are doing takeout and delivery for restaurants that manage to stay open, they might have a $25 monthly payment on their IDR plan, and they would get no relief, even though they're not earning a lot in the first place. We're talking $25,000 or $30,000 a year, and they're working hard in the midst of a pandemic to ensure that the rest of us have food to eat, for instance. They would get no relief from that particular compromise. So if we want to talk about targeting, we got to be careful to create the right target, to tailor the relief to the people we know need it, and to ensure that we're not leaving people out. And as soon as we start limiting the number of the dollar amount of relief for an individual, we're implicitly targeting. So you got to make sure that we hit all the people who need relief. And I think there's a case to be made for that all student loan borrowers need relief. And Marco's made the case that there's a broader impact on the economy for this relief. And so I think we want to keep that conversation going. I also wanted to circle back to just highlight some of the other implications of the racial wealth gap here. I like that we're talking about wealth and also income, and I wanted to make sure that we're not missing out on segments of borrowers who, and we've seen this particularly for Black borrowers, for whom a degree doesn't necessarily insulate them from facing default. And also we see that high income among Black borrowers, though that may also be correlated with high debt burden, doesn't necessarily translate to a smooth road through repayment. There's also the risk of default. So when we're thinking about legacies of systemic oppression and economic disparities that are baked into both our labor markets and into the wealth portfolios or lack thereof of households of color, we really have to be careful that we're not jeopardizing nascent wealth and the ability to generate generational wealth or build assets within low-income households, because one person who went to college had to get an additional degree in order to get the credential that would enable them to put their family on a stronger path financially. So when we think about who needs relief, we should also be looking at graduated relief. In the HEROES Act, there's a cliff. You earn $1 over this amount, essentially you get no relief whatsoever. Those cliffs are really dangerous, especially when we're talking about something as nuanced as this. And they would inevitably result in arbitrary forgiveness decisions. You either get zero relief or you get $10,000 of relief based on a cutoff. That doesn't make sense. And also when it comes to essential workers, there are also folks everyone who is laid off since March 13th would not get any relief under the HEROES Act. So it doesn't meet the moment to the extent that this is a response to the COVID-19 crisis, we got to make sure that folks who've been harmed, who've lost their jobs during the pandemic, are eligible for relief too.
I'm hoping all of you can talk to me about this, but Joanna, I'm very interested in what you have to say as to how has COVID-19 complicated existing challenges for borrowers?
Right now, we know that folks are hoping to keep their jobs, hoping to stay healthy, and some folks have lost their jobs already, and some are already ill or are facing family illness. So when it comes to repaying student loans, we know the stress and anxiety that borrowers feel sometimes has an impact on what they choose to do in these circumstances. How do we make sure that folks can keep their families healthy and safe at the same time that we know that there are these underlying economic pressures and the drain of carrying the debt? So right now, we know that it's really important to ensure that folks have the breathing room they need to make ends meet without having to worry about making their student loan payment today, or about worrying about how they're going to make that payment tomorrow. Because if they don't have a job today, they're trying to put food on the table today. And they also don't know whether they're going to be able to pay for their debt later. So we know that families need money now to pay for crucial essential expenses, and we know that they're going to need money for those same expenses later. So we need a solution for dealing with the debt that they're carrying now and the debt they'll carry later unless we cancel it.
Yeah, and just to piggyback off that, another struggle facing borrowers right now is how the loan payment suspension was operationalized and designed. So as we touched on, only 80% of borrowers are covered by the suspended payments. So they suspended the loans that were directly issued by the federal government, other loans that the federal government owns. But there are a lot of loans that are issued by private lenders, but the federal government backs these loans. They're no longer being issued. These are legacy loans from 10, 15 years ago. And these loans you still have to make payments on them. The complicated thing is some people hold both direct loans from the federal government and federally backed loans. And the federal government framed this whole situation as, oh, loan payments are suspended. So if I'm a borrower and I hold one direct loan and one federally backed loan, I'm expected to make a payment on that federally backed loan, but my payment on the direct loan is suspended. It's just really confusing, and especially for folks with multiple loans. And so there's going to be borrowers who go into delinquency without realizing it, and it's just a very big mess.
In addition to that, I mean, there is also the private student loan market, right, which is sort of not covered so far. And if you think about who goes to the private student loan market, is either the ones that are top out of the federal funded, or the ones that go sort of to for-profit university, which I think are sort of on the left tail of the distribution and might need some relief during the pandemic. And so you are sort of left to the states to negotiate agreements with different servicers. And I think we are at 11 states in the District of Columbia that got to in some type of agreement, but there are also many servicers among some of the biggest one in the country that sort of didn't get into any of these agreements to provide relief under the umbrella of saying we want to sort of maintain some type of flexibility to help our customers. But sort of we know what that really means is that sort of when you go to in a case-by-case basis, it becomes significantly more difficult to negotiate some type of relief for these customers.
Yes, I completely agree. We need to cover all federal student loans, and we need to be looking at covering private student loans too. And when we talk about federal student loans, I like to make sure we keep Perkins loans on the table because those are held by institutions of higher education, unless those institutions have assigned them back to the Department of Education. And there are more than 1 million borrowers who have Perkins loans, and they also need the kind of relief that other borrowers of federal loans got in the CARES Act.
I think one of the things that's interesting about the CARES Act is how challenging it seems to execute some of the pieces of that impacts higher education, especially borrowers. There are still people who are having their wages garnished. There are still people who are waiting for refunds, who had their refunds taken from them after the fact. And I worry and I wonder what you guys think about, how do we ensure that there's like an elegant way to execute cancellation or any other policy that could be most beneficial to the population that we're talking about now? How do we create a system or execute a system that doesn't have all of these hiccups along the way?
That's a tough question.
Yeah, I try.
If you want to do a loan cancellation policy, I think a lot of thought should be taken on how to best target these federal resources to get at the populations that you're concerned about. Because in a worst case scenario, you would just forgive everyone's debt, and it would be like the 2018 tax cut where everybody gets a little relief, but the majority of the federal support goes to the top of the income distribution, folks that took out $200,000 in debt to go to an MBA program or a law program, and they can work from home during COVID-19 and they're doing okay. These resources should really be targeted towards financially vulnerable folks. Also, if you want to undertake a widespread student loan forgiveness plan, there needs to be something done about price at the institution level, and then also quality. So there are a lot of schools that provide very poor return on investment for students. For example, at for-profit credential granting programs, the average student actually leaves school worse off than someone that didn't go to school at all, because they received no ROI on that degree, and yet they had to pay money, and there's the opportunity cost of time. And they can use federal dollars to go to these programs. So if we forgive everyone's debt now without looking at these larger quality issues, we're going to be in the exact same place we are a few years from now. And then price is the same issue. Prices keep going up. I mean, obviously, colleges' business models are going to be changing as a result of COVID-19, but we've seen prices continue to rise, especially cost of living for dorms and housing in regional housing markets. Student loans cover housing for students as well. And so unless you can get at these cost drivers, it's really just going to be a very expensive Band-Aid on a much larger problem.
I'm seeing Tim back
Everyone?
on.
Yeah, I would.
Yeah, popping back in for the Q&A. Go ahead, Joanna.
I was just going to offer that it's, in a lot of ways, debt cancellation is both a way to treat and cure our ongoing student loan debt crisis and our student loan default crisis. And if we want to think about front-end interventions, the most important thing that we can do is make sure that we're moving forward with debt-free college for folks going forward, so that we're creating a system where we get rid of the debt that folks have been carrying at great cost to themselves and at great risk to themselves and their families, and ensure that we're not saddling students of the future with the same kind of burden. And the more debt we retire, the more leeway we give ourselves to redesign a system that is equitable, that is fair, and that doesn't leave folks at risk of servicing errors, debt collection harassment, and the other kinds of things that we know both increase the cost of repayment and increase the amount of time people spend in repayment, and are the things that far too many low-income borrowers and borrowers of color face in our current broken system.
Thanks, Joanna, and thanks everyone for this great conversation. We've got a few questions from the audience that I wanted to dig into, and one of them was about a specific kind of version of this. You've all talked a lot about kind of the large-scale total forgiveness versus targeted, and a little bit about the HEROES Act. One of the flavors of cancellation has been forgiving $10,000 of loans for everyone. That kind of reduces the cost and doesn't mean that kind of really large balances that folks from who have had graduate degrees and some of them are doing well from getting total forgiveness, but really focuses on the folks with a lower burden. I'm wondering how folks on, particularly Joanna, and Kenny, who've been following this stuff for a while, feel about that as a trade-off between targeting and widespread cancellation?
I'd say when we talk about widespread cancellation, we often think about broad-based cancellation. So how many people does that touch? And so to the extent that it would be $10,000 for any student loan borrower, so we're talking about the 45 million Americans who have student loan debt, that's broad-based or widespread debt cancellation. And as I mentioned earlier, whenever we start to attach a dollar amount to the amount of forgiveness that any one borrower can get, that's when we start targeting. So when we think about $10,000, there's implicit targeting, and we can look, there is some data to show who would be affected by $10,000 of relief. As you heard earlier, as we've talked about on the panel, low balance borrowers just make up a disproportionate share of folks who are in default right now. So $10,000 of cancellation across the board would provide incredible relief to people who are in default. So retiring their debt completely and ensuring that it's not a drain on them or on our economy. So there's some elegant things about choosing $10,000. It's administrable. We don't have to do a means test. We just give everyone $10,000 of relief, and we can really take a swing at solving the default crisis for many people, including people of color who so disproportionately face default, at the same time that we're thinking about how to move the needle on the economy and recognizing that student loan debt student loan debt relief and cancellation could really help stimulate our economy at this time.
Yeah, and well, $10,000 per borrower, you would still be providing support to borrowers who are doing well for themselves. But that said, as Joanna mentioned, most struggling borrowers, or a lot of struggling borrowers, hold less than $10,000 in debt. Also, that dentist that has $200,000 in debt, $10,000 makes up a relatively small portion of their total debt load compared to a borrower who's delinquent with just $10,000 in debt, in which case it would be 100% of their debt. So in that sense, it's better targeted than full debt cancellation, but you would still be providing significant benefits to folks with the ability to repay.
One of the questions that we got even entering this conversation, we've touched on a little bit, is how to make sure that our student loan and higher education reforms has equity as a lens to make sure they reach the people who have been hurt most by this. And I'm curious, not just from the panelists, but also Danielle, if anyone wants to take this on, is how to make sure that the policy design includes equity as a lens. Is it just making sure that any policy is widespread and reaches everyone, or are there other ways to target or other possible reforms that would really help us move the student loan system to a more equitable place?
Well, I'll just say, in my own reporting, I think paying attention to the differences between wealth and income, especially for African-American borrowers, is very important. You know, for a while there was a line of coverage where it was, you know, don't worry about grad school debt, or don't worry about people with graduate degrees, they'll be fine. But when you drill down into the data, when you start talking to people on the ground, especially when you start talking to African-American borrowers, even if they're not first generation, oftentimes they're no more than a generation or two away from not having resources. And so we have to pay attention to that in any kind of policy prescription, because it is far more nuanced than some of what we're hearing from lawmakers. And it's difficult to get at that. But I think that there's been a lot of great work done by a lot of policy folks looking at those issues in a more meaningful way, and hopefully that could drive conversations about reform. One of the things that's you know, a bit disheartening about having to deal with this crisis is that for a second it seemed like there was going to be meaningful higher education reform coming through HEA. There seemed like there was real momentum, though I got to say, I probably say that every single year. Year is going to be the year. And we all write that story. But it really seemed like it was going to happen. And it was going to happen in a way where people were paying more attention to that. I don't know if that's going to be sidelined or put on the back burner because of what we're dealing with now, which makes a lot of sense. But hopefully, whenever it does get picked up again, folks are paying attention to how this crisis also affected various populations, borrowers of color, borrowers who are first gen, and paying attention to making sure that whatever we build out of this addresses the fact that they have a dearth of resources and borrowing becomes the only path towards accessing higher education. How do we affect that and help them along the way?
And going back to going back to other policy prescriptions here, historically, Black colleges and universities have been historically underfunded, so have community colleges, and I think providing these schools with far more resources than they're getting now is one way to help the system moving forward, because there are just major capacity constraints based on different sectors.
Thanks everyone. And then I'll get one last question before we close out, which is, and I'm really curious about this. We've talked a lot about the federally held student loans, but not about privately held student loans. Are there any policy prescriptions for folks who have those loans that have come on the table or that you suggest?
Can I interject, maybe say just one thing about that, which is that it always sounded very strange to me that the private student loan market has the same guarantees as the federal one, like for example, the non-dischargeable being non-dischargeable in bankruptcy, but does not offer at times the same benefits to borrowers. And so the fact that, for example, I can go to an income sharing plan that is pretty convenient and a forbearance plan and so on, this is sort of left as a choice to each one of these lenders, rather than as a potential benefit that comes as in the form for the federal. And so sort of equalizing the situation between the federal funded one and the private loan market is sort of, I think, one potential objective of policy interventions here.
Great. Well, we're at the top of the hour, so I want to thank Danielle for moderating this wonderful discussion, and Marco, Joanna, and Kenneth for joining us for a really important conversation, I think, right now about making sure that we don't take the eye off the ball in terms of higher education and student loans as the pandemic continues. So thank you all, and thank everyone who joined the stream for tuning in. Make sure a lot of the themes of this conversation are also going to be in our conversation next week, which is on managing, collecting, and forgiving consumer debt, lessons for policymakers and business leaders. So in your thank you email, you'll find a link to that. Please register, and thank you all for joining us.
Thank you.
Thank you.